Joining me now, George Seay, founder and chairman, Annandale Capital. George, great to have you back. Thanks so much for joining us.
My pleasure, Caroline. Glad to be here.
So, George, the strength of the AI rally has really been called into question this month. It's trying to make a comeback right now, but are you still a believer? Is it fizzling or is there room to run, George?
I don't know how much room there is to run, but it's not fizzling. It's stopping and starting and backing up and moving sideways. It's all over the place because nobody really knows what to think right now. But nobody really wants to put on a full-on bet against the market and the AI trade because it's worked so well for so long that people are really reluctant to give it up. And now you have kind of changing horses in terms of people that stocks that people are most excited about. You've gone from Nvidia, Microsoft to Nvidia to Microsoft to Google to Amazon to Google, and now Google, which was kind of the laggard for the first 2/3 of this year, is now at 70% for the year and is the new hot AI dot. So I think it does still have legs. I don't think it's going to expire until we get a dramatic slowdown in CapEx or a recession or flat economic growth or all the above. But I think you're squeezing the last few puffs out of the very short cigar at this point. I don't think it's going to just keep going up forever. Gravity does take effect at some point.
Okay, so it has legs, but it sounds like you think it's very close to the end. Are you concerned at all that AI is a bubble?
Well, I think that it's very clear that some elements of AI, companies that are just off the ground, just starting up, with no revenues, no earnings, no nothing, are clearly in a bubble. I mean, you look at the data center company that went public in the panhandle of Texas this year, IPO'd at a market valuation of close to $20 billion, and they're not going to have any revenues or earnings for many, many years, if ever. That clearly that segment is speculative at best. Google, Microsoft, Nvidia, these are not speculative companies. These are the greatest companies the world has really ever seen. And so the question then is a relative one of what do you pay for this earnings growth and what's it going to be? And that's where the simple analysis becomes very complex, because that's a really hard question to ask when you get into relative valuation and what you should pay for things.
Okay, so even if pieces of AI are actually in a bubble, if and when it bursts, what would the fallout look like?
I think you'd see in companies that may never arrive, there's a lot of enthusiasm, there's a lot of energy, a lot of speculation right now, and they're all performing at very high levels. It's very reminiscent of the internet bubble 25 years ago. It's hard to believe that's 25 years ago, where a lot of these companies are going to go away or fade away or never arrive. But the mainstream companies that have very real profits, very real revenues, and very real growth, they're just going to try to find their best spot from a valuation perspective, and that's going to be a process, not an event. And when the growth rate of all this slows down somewhat, you're going to find people that they won't pay 45, 50 times earnings for these companies. They'll pay 25 to 30 times earnings, and that can be a painful short-term correction, but that's what it is. It's short-term. It fades eventually. You look at Microsoft, and the stock traded at $58 in 2000, then it traded all the way down into like the teens in the subsequent decade. It only captured $58 again in 2017, 17 years later, and today it's almost $500 a share. So these are processes, and they can take a very long time and test the patience of everyone. But it's fun while the party lasts. I don't know if people remember Michael Prince, the infamous CEO of Citigroup, right at the tech bubble bursting in 2000, and he said, "While they're playing music, you got to dance. When they stop the music, it can be pretty abrupt. So you want to spread your bets around."
Okay, so just one more question about this and then we'll broaden it out. But if we do see that correction, are there any companies that you think are safe when the music ends?
Yes, I do, actually. I think that Microsoft and Amazon and Google are all readily investable. I was very high on Google about 6 months ago when it was trading under $200. In fact, trading closer to 100 at one point than 200. But now that it's surged so much and is well over 300, souring on that from a timing standpoint, I'm much more interested in Amazon, which is lagged behind this year, and Microsoft, which is way off its highs. some of these companies are very investable and they're great long-term investments. So I'd be looking more towards those than on a speculative company with no revenues, no earnings, or the hot dot of the moment. These things have real momentum around them and real popularity contests, and you want to play a contrarian a little bit with some of them.
Okay, so let's broaden it out, because I would say it sounds like you're maybe skeptical of the AI rally at this point. What about the overall market right now, which we know the AI rally has really powered higher? Can you make the case that stocks will continue to rise from here?
I can. We have not bet against the market. We have not pulled out of the market. We've kind of maintained positions and looking to add in areas that are less so dearly loved. And you look at the S&P 500 on a market weight basis and the S&P 500 on an equal weight basis, and the differential in the price per earnings multiples is dramatic. It's almost a 40% differential. And if you buy the S&P 500 on a market weight basis, you can buy stocks well under 20 times earnings and well under a market multiple. So we've been starting to look more in areas like that we think might do quite a bit better than some of the more speculative companies in 2026 and 2027. And part of that trade for us is the insurance industry, which is trading barely above book value and single-digit multiples of earnings with high dividend yields, and natural gas stocks, which still have quite a lot of upside coming up in the huge LNG trade with overseas liquefied natural gas trading, and with the AI data center trade. They're still trading at very reasonable valuations for how important they're going to be to that huge growth in electricity demand and natural gas demand.
Okay, so insurance, nat gas. Talk to us about some of the other changes you're making to your portfolio as you think about year end, but also as you think about the new year.
Yeah, we're doing quite a bit of overseas and international and emerging market stocks as well to try to broaden diversification away from just Mag 7 and large S&P 500 stocks. So we've got some more exposure to less loved parts of the world, like the emerging markets, and the international developed, like Japan and Europe and places like that. And then we're also trying to buy some very unloved, great franchise companies. PepsiCo's had a terrible year this year. Everybody's down on them because people are drinking more Coca-Cola and Dr. Pepper than Pepsi, and they're down on Lay's potato chips. And we think that's a great franchise, great company that's fallen on hard times, and you could buy it at a reasonable price. So we've been slowly layering into that company, and there's several examples like that. It's just a normal market rotation and market progression away from areas that we think are not very attractive from a next 5 years perspective, and into companies that we think are.
Okay, I was taking a look at your notes, and you said stocks are objectively expensive and the next 10 years won't look like the last 10. So level set our expectations here. What level of returns should investors actually plan for as you think about the next 10 years?
Yeah, it's really interesting for me as someone who's been doing this in my company for 28 years, and you look at all the bipolar nature of the market and how it gets euphoric and then it gets in despair, and how things change so much. And we try to think in decade-long terms, because you really want to make money over the long term and generate long-term capital gains instead of trading and paying excessive taxes. And so when I look at the market from that basis, and the fact from 2009 until now, it's been almost straight up and to the right, except for the pandemic and very brief episodes. So that kind of mid-teens return that people have seen over that period of time, historically, that's completely unsustainable. You just can't keep that up. Stocks typically return around 8 to 12%, and we've been well up above that for quite some time. So if I'm an investor, I'm shooting for the market historical average, which is 10% before inflation. A pre-inflation return, or a real return of more like 6 to 8%, something like that, depending on what inflation is. And I would try to hurdle at least 5%. I think somewhere in that range is realistic and doable. But if you start thinking I'm going to make 15% forever, I think you're going to be really disappointed.
Okay, so the S&P 500 is up 14% so far in 2025. Do we end the year higher or lower than where we are now?
Higher. We're not done with Turkey and Santa Claus rallies. They're still coming.
All right, George Seay, founder and chairman, Annandale Capital. Thank you so much.
Thank you.